Financial statements are formal records summarizing the financial activities and position of a business, organization, or individual. They are essential tools for understanding the financial health of an entity and are used by various stakeholders. There are 4 primary types of financial statements that businesses typically prepare: balance sheet, income statement, cash flow statement, and statement of changes in equity. Balance sheet. This statement provides a snapshot of a company's assets, liabilities, and owner's equity at a specific point in time. It follows the accounting equation: assets equals liabilities plus owner's equity, helping assess liquidity and solvency. Income statement. This report summarizes revenues and expenses over a specific period, showing net income or loss. It is crucial for evaluating profitability. Cash flow statement. This statement tracks the flow of cash in and out of a business, divided into operating, investing, and financing activities. It provides insights into how well a company manages its cash position. Statement of changes in equity. This document outlines changes in owner's equity over time, connecting the income statement to the balance sheet. The main purpose of financial statements is to provide relevant information for informed decision-making regarding investments and performance. While financial statements offer valuable insights into an organization's financial condition, they also have limitations. They may not capture all aspects of business performance or future potential due to factors such as accounting policies, estimates made by management, or external economic conditions. Additionally, they rely on historical data which may not always predict future performance accurately. In summary, financial statements are essential documents that summarize an entity's financial status at specific points in time or over defined periods. They play a vital role in decision-making processes for various stakeholders.